All right. Now on to part 2 of lecture 5. So here we'll look at one form of disintermediation. In fact, the most popular form of disintermediation, which is called peer-to-peer lending. And we'll see what this actually means, how it tries to replace existing intermediaries, and some of its advantages and probably some of its drawbacks as well. So what is peer-to-peer lending? Well, the broad definition is these are nothing but two-sided matching markets where, on one hand you have capital seekers, which are, let's say, firms and individuals that need access to money. And on the other hand, you have certain set of investors that want to invest their money for certain purposes, either it's higher returns or reducing risk. So the standard definition applies. But what is the difference here? In a P2P platform or in peer-to-peer lending, you don't have an intermediary, essentially. Instead of an intermediary, which takes care of, accepting deposits and issuing them as loans, you have just a platform that acts as a much more seamless interface. Okay, it operates in a digital environment, meaning most of the business is conducted online. And here, unlike the case with traditional financial intermediation like banking, these are two-sided matching markets where the borrowers and investors can interact directly with each other. Right? In banking, we saw that was not possible. The depositors, the investors, met with the bank and provided their deposits, and the bank issued money to borrowers, but the depositors and borrowers didn't necessarily meet each other. They don't know who each other is. But here in a P2P platform, that is abstracted away. So the platform takes a backseat and does the job of allowing investors and borrowers to interact and know about each other before the investment happens. So the first peer-to-peer platforms emerged in around 2005-2006 in the US, and this whole notion of P2P lending started with Prosper and then moved on to Lending Club. So Lending Club, as we'll see shortly, is the largest platform in existence today. What is the main purpose of peer-to-peer lending? Like in the first lecture, in the first part, we saw that there was this huge notion of financial inclusion, or the lack of it, and that many segments of society were excluded by traditional financial intermediaries. So the main purpose behind starting these P2P platforms was to facilitate financial inclusion, was to serve these underserved markets, like I've been saying. And P2P platform is nothing but a form of crowdfunding. In fact, the largest form of crowdfunding, and also the most popular form of crowdfunding. Okay. Now, what are some of the main features of P2P lending? Well, as I said, this is a disintermediated market where most of the loans are rather unsecured, meaning no collateral is provided, and most of the loans are generally short-term in nature. Of course, P2P lending has evolved over the years, and now you see a lot of P2P players who are also offering loans on longer terms, offering larger and larger loans, and also offering loans for businesses. But this was not necessarily true when P2P lending started as a phenomenon. How do P2P platforms resolve information asymmetry? That is, after all, the main purpose. That is, after all, a precondition for providing a loan, right? So if you take banks generally rely on hard information, like your credit scores. They use your credit scores like FICO in the US or Dun & Bradstreet data for firms to determine your creditworthiness. Okay. Of course, P2P platforms also employ hard information. They use FICO scores for individuals and Dun & Bradstreet data for firms, depending on who the borrower is. But apart from this, P2P platforms also rely extensively on soft information. What do we mean by soft information? Well, this is information like referrals from investors, meaning if an investor knows a certain borrower that needs money, he or she can be introduced to the platform. And therefore, there would be some kind of a recommendation from an investor saying that this borrower is creditworthy. That's obviously soft information. Additionally, information can also be provided by the borrowers themselves. So, for instance, if you go to any crowdfunding platform like Kickstarter or Indiegogo, you'll see that people seeking funds on these platforms provide extensive information on the project that they are willing to use the money for. So for instance, if somebody is trying to raise money on Kickstarter for making a new watch, they'll provide videos, very attractive videos of what this new watch is, how many units will be produced, what its main features are, how different will that watch be from other watch manufacturers out there, and things like that. So all this information is being provided to increase transparency on the platform. Okay, and obviously the success of resolving that information asymmetry on a P2P platform also depends on to what extent that information asymmetry is resolved between the investors who provide the loans and the borrowers. So the P2P platform will sort of take a backseat in trying to resolve that information by itself. Obviously, how do P2P platforms achieve this objective of resolving information asymmetry? Most of them are fully automated platforms, meaning there is minimal human involvement, and they are able to achieve this by using many advanced mathematical methods under, let's say, machine learning or big data analytics. So we saw that in the case of Wonga, right? So I selected the loan, my requirements as part of my loan request, and the P2P Wonga made an instant decision on how much to charge, whether it was first willing to provide me a loan and things like that. So what this does is P2P platforms are not only trying to improve financial inclusion, but they're also trying to facilitate access to financing in a cheaper and faster manner. Now, obviously, this is a generalized overview. We saw in the case of Wonga that the interest rates charged were higher, but that kind of predatory behavior, I would say, is rather an exception than a norm. Okay. Now, P2P platforms are also regulated by the respective regulatory authorities, depending on where they are domiciled. So, for instance, in the US, most P2P platforms based there are regulated by the Securities and Exchanges Commission. But the problem is the level of regulation, the level of scrutiny that these P2P platforms face is far lower compared to what banks are subject to. Okay? And obviously, this has allowed some of these P2P platforms to indulge in the kind of predatory, in the kind of exploitative behavior that many of them have been indulging. What are the key functions of a P2P platform? Well, it performs some of the basic functions that are required to service a loan, to originate a loan. So for instance, a P2P platform has an interface, provides an interface to receive loan applications. It uses algorithms to screen prospective borrowers and determine the creditworthiness. But the added element here, unlike a bank, is that a P2P platform will provide information on the loan request and on the borrowers to the investors who will fund that loan. This is not something that a bank does, right? A bank doesn't provide information on the loans to all the depositors. It makes the decision itself. But here, a P2P platform does not make that funding decision. It leaves that decision to investors. Okay? And as I said, there is minimal human involvement because there's no loan officer sitting behind that website, like in Wonga, making the decision whether to issue a loan or not. All of that is pre-programmed and automated to the fullest extent possible. What does that do? It allows for processing of loan applications in a quick and cheap manner. And obviously, because there is minimal human involvement, the need for hiring a lot of people is reduced. So there is less personal expenses. There is less requirement to rent office space or buy office space. And obviously, the cost of processing documents, paperwork, and indulging in maintenance is all reduced. And these days, most P2P platforms have moved their operations online, meaning most of the data storage, all processing, etc., is being conducted on cheaper and cheaper platform technologies like cloud computing. So this is helping them drive down the costs of their operations more and more. Okay. How does P2P platform work in general? So typically, the process starts with a borrower making a loan request, just like I did on Wonga on the website in the previous video. What does a platform do? It instantly evaluates my creditworthiness based on the information the documents have supplied. And once it determines that I'm creditworthy, my profile, my loan request is actually posted on the website, on their platform. And that loan request is visible to all kinds of investors out there that lurk on the other side. So for instance, the investors could be individuals who save their money, typical depositors, who are not happy with the bank, who probably are not happy putting their money in a bank and seek higher returns. It could be large institutions like hedge funds or pension funds that also are looking for alternative investment channels. And it could also be high net worth individuals, meaning these are investors who have a lot of money. And unlike depositors who simply want to save their extra money, these are guys who, like Bill Gates or Jeff Bezos, who have a lot of money to spend and they want to invest in these alternative markets. Probably some of these investors also want to achieve some kind of goodwill, meaning they want their money to have some kind of a social impact. You see this with Bill Gates, right? If you follow news on his activities, on his philanthropic activities, you see that many of these rich guys want to use their money for some social good. And they see P2P lending as one avenue to achieve that purpose. So what happens? The loan request, my loan application is posted online, and all these investors can look at these loan requests, this list of loan requests, and they can determine whether a particular loan request is something they wish to invest in. So once they make that choice, interested investors can purchase the relevant loans, meaning they can fund those loans. And once they make that purchase, the debt contract is issued. So the loan request is processed, the loan is issued, money is directly deposited into the borrower's account, and a relationship between the borrowers and the investors is established. Okay, and obviously the platform takes care of all the loan repayments, so it keeps track of when the borrowers are repaying their loans and takes necessary action. How does a P2P platform make its money? Now, a bank made its money based on the difference between the interest rate it charged borrowers and the interest rate it paid to the depositors. Unlike that, a P2P platform makes its money mostly on commissions. So it charges a fee for processing the loan requests of borrowers, and it also charges a fee for all the money that investors put into these loans. And that's how a P2P platform makes its money. But the catch here is, as I said, the P2P platform is not necessarily acting as an intermediary. It is only acting as an interface. So what does that entail? The money provided by investors is directly provided to the borrowers. So the P2P platform doesn't hold any deposits. It doesn't keep any money with itself. So the money provided to P2P platforms is in fact treated as an investment. So what happens to the default risk? The default risk, if the loan goes bad, it is the risk of the loan going bad is borne by the investors. The P2P platform doesn't bear any of that risk. Okay? Because because the money provided doesn't exist as a deposit on the P2P platform's balance sheet, it doesn't have to face any kind of constraints between matching its assets and liabilities. Meaning, we saw in the case of the bank that it has to match its assets and liabilities, right? It has to match between its deposits and loans. What happens if there is a mismatch? If there is a mismatch, we saw in the last lecture that there is always a case of the threat of a bank run, right? If a bank issues more loans compared to the number of deposits it expects to be withdrawn in the next period, there is definitely a threat of bank runs. But here, in the case of a P2P platform, because it doesn't face that threat, because it doesn't keep that money, there is no need for it to match its assets and liabilities. That threat vanishes. So what happens? Because a P2P platform doesn't maintain any deposits, it doesn't face any kind of reserve requirements, minimum reserve requirements, let's say under the Basel guidelines. Now, P2P lending actually combines some traditional methods of banking with informal lending mechanisms. So what are informal lending mechanisms? These are money that you could possibly raise from your friends and family, conditional on them having that money. So if you had to raise money from your parents, it would take less convincing. As long as your parents trust you, it would take less convincing to get money from them. And the money is definitely provided as quickly as possible from your friends and family, right? So what P2P loans do? So P2P platforms actually allow you to raise money in that quick fashion, right? So the money is granted in a short time, and the P2P platforms are able to do this because they use a broader information set to make that lending decision, to process your loan request. And because P2P platforms have lower operating costs, they're able to make that process much more streamlined. And the financial crisis that we talked about so much in the last lecture actually has helped P2P platforms. How? Because Basel III, that was introduced as a response to the financial crisis, increased the regulatory requirements, the capital requirements on banks, but it didn't have any such requirements on P2P platforms. So banks became more conservative in their lending practices as a result of Basel III, which obviously opened up the market space more for these P2P platforms to capture. So P2P platforms actually have experienced tremendous growth since the financial crisis, partly due to the enactment of Basel III. What about the cost versus benefits? Do P2P platforms provide benefits to borrowers and investors? Well, sometimes they do. So for instance, if you look at borrowers, obviously borrowers face lower screening costs because most of the loan processing is done through machines, through algorithms. Most of these loans are also unsecured, meaning borrowers don't necessarily need to have assets in place to be provided as collateral. And there is also no threat of bank runs, right? Because the P2P platform doesn't keep any deposits and faces no threat of bank runs, and most of the default risk is borne by investors, any request for early repayment has to be made by the investors themselves. So the P2P platform doesn't face any threat of bank runs, nor do the borrowers. But the catch here is that borrowers face very high interest rates. We saw that in the case of Wonga, right? And that's rather, one of the key reasons why that is happening is because, again, P2P lenders face less scrutiny from regulators. What about lenders or the investors active on these platforms? Obviously, they are in it for a reason, which is rather than provide the money to banks as a deposit, by investing in a P2P platform, they can earn higher returns. So that's one major attraction. There is also no risk of losses because, especially if the P2P platform goes bankrupt. Why is that? Because, like, as I said, the P2P platform sort of takes a backseat. It acts as an interface and not necessarily as an intermediary. So because of that, and because investors and borrowers interact with each other directly, there is no risk of the loan going bust or the investment going bust if the P2P platform collapses. But what is the problem here? Now, we saw that the P2P platform resolves information asymmetry, adverse selection problems before the loan is issued, right? It assesses the borrower creditworthiness. But the P2P platform doesn't necessarily take responsibility once the loan is issued. That responsibility falls on the investors themselves. So there is definitely a risk of moral hazard faced by investors because the P2P platform doesn't take that responsibility of monitoring the performance of the loans. All right. What about costs? If you look at the distribution of costs of banks versus P2P platforms like Lending Club, you see that banks face significant costs because they need to maintain branches. They face a lot of operating costs because they depend on a lot of paperwork. They need to print bills. They need to set aside money for fraud, possible fraud. They also need to expend costs for collecting their loans and things like that. They also face a lot of costs in originating loans because, what do banks do? We studied that they perform extensive credit analysis, and that requires people on the ground. That requires investment in IT and things like that. So they face a lot of costs in originating loans, and they also face significant costs in maintaining an IT infrastructure. Of course, the infrastructure in most banks is sort of outdated compared to what P2P platforms have, but nevertheless, having a computing infrastructure has certain costs. Banks also face regulatory costs. This is shown here in the form of FDIC fee, but because banks are subject to stringent regulation, they also face costs in in satisfying all those regulatory requirements. And therefore, consequently, you can see that the cost borne by banks is significantly higher compared to the cost borne by P2P platforms. What are the major costs that P2P platforms face? Well, because they don't have an they don't have any physical presence, they don't maintain any branches or ATMs for that matter, they virtually have no physical expenses, right? They do have to deal with certain paperwork, like issuing certain bills and things like that. But the cost of paperwork and operating costs are slightly, in fact, far lower. P2P platforms, however, tend to spend a lot of resources and money on marketing themselves compared to banks, and also spend a lot on maintaining an IT infrastructure because that's what their business relies on. And therefore, a major part of their expenses goes towards marketing, goes towards advertising themselves, and also towards maintaining their IT facilities, their computers, their cloud computing infrastructure, and things like that. But ultimately, the overall cost, the aggregate cost of a peer-to-peer platform is far lower than the cost of a typical bank. And what happens as a result? Because of the significant cost savings borne by a P2P platform, borrowers are able to borrow loans at slightly lower rates, and P2P platforms are also able to offer higher returns to investors. So there's a win-win in general terms for both borrowers and investors, which is also one of the reasons why many of them are attracted towards these P2P platforms. Okay, so if you look at the evolution, the growth of most peer-to-peer platforms, you'll see that most of these platforms have been on an upward trajectory. So here's an example of the growth of Lending Club since the last 7 years. And this is directly from Lending Club's website. You can obtain it immediately. But you'll be surprised to see that Lending Club, which is the largest online P2P platform in the world, all over the world, was able to issue about $56 billion worth of loans in the last year itself. Or I think this is the overall loan issuance since the last 7 years. But until 2019, it was able to issue up to $56 billion. And this is the same. The story is the same for all peer-to-peer lenders, whether that's in the US, UK, Europe, or elsewhere. Most of them have experienced significant growth. Okay, so the story I want to tell you here is this peer-to-peer lending market has experienced tremendous growth because of all these benefits it provides, because loans are issued at much quicker pace, and because both investors and borrowers benefit from their presence. But again, the catch here is because of lax regulation, because peer-to-peer platforms have been able to find loopholes within the regulatory system, many of them have been able to indulge in exploitative behavior, like we saw in the case of Wonga. All right, so this concludes our second lecture. Thank you very much.